Good morning. I hope you're well and enjoying the school holidays and that you are dialing in from somewhere peaceful and relaxing, just like the markets were in June. We had a generally upbeat market after a very difficult May. June came to the party. Looking at June market performance, you can see there that everything was up. It is masked by the Rand. The Rand was 4% stronger for the month as it came back from its very stretched levels after May. But if you add back the 4% Rand strength, you can see that pretty much everything was up for the month. The markets recovered thanks to US debt ceiling being raised, lower energy prices, the fact that the US Federal Reserve Bank paused, and most importantly, resilient earnings. And the fact that growth continues to be resilient despite high interest rates and high inflation globally. And as a result, gold fell back during the month. You can see they're -7% for gold, as there was less reason to be pessimistic about the outlook for the rest of the year. But the end of June brings us to the end of the first half of 2023. Can you believe it? Halfway through the year, I can't even imagine where it has disappeared to so quickly. So let's see how markets have done for the first half of 2023. And looking at this chart, pretty strong. Unfortunately, again, the Rand is masking a lot of movements. The Rand is 11% weaker over the first half of 2023. That's the bottom gold line there, US cash. You can see the Rand is 11% weaker, and that has pushed up all returns to pretty strong levels. But even taking that out, you still got double-digit returns on most asset classes. FANG being the outstanding performer, nearly doubling over the last 6 months, 92% return in Rands for that index, a phenomenal return. And that has certainly buoyed markets globally. The FANG stocks are the global mega caps. So the fact that FANG has done so well has pushed up US equities almost entirely. US equity performance has been driven entirely by the top 8 stocks in that market, the FANG stocks. And because US equities make up so much of the world, MSCI World, so world equities have also been driven up very strongly this year because of the FANG stocks. So a very narrow breadth for the first half of 2023. FANG in particular has driven most markets this year, with other regions not doing quite as well. But the standout worst performers certainly are South African assets. You can see there South African equities up 4% compared to world equities at 27%, South African bonds up 2%, SA cash up 4%. So the 3 worst performing asset classes in the first half of 2023, all South African. Fortunately, we did, as you all well know, we changed our strategic asset allocation at the end of last year and took more money offshore. Obviously, we wish we'd taken more, but we are South African investors. We do have to worry about Rand volatility, and but that move has certainly helped us. Having more offshore assets has definitely helped. South African assets definitely looking very cheap, certainly very cheap after they've lagged the rest of the world. But we do need to remind ourselves that the entire Johannesburg Stock Exchange, the market cap is only $1 trillion. You say only one? It's $1 trillion. It does sound like a lot. However, in the month of June, Apple surpassed the $3 trillion mark. One company in the US, 3 times the size of our entire stock exchange. It's just quite incredible, and not only humbling, but it does bring into the question of South Africa's relevance in the world. And certainly global fund managers, I'm sure, think twice before they look into South African investments, particularly with all the risks that abound. And that's just why we are cheap, and we may be cheap for quite some time, and why we have certainly taken more equities offshore and reduced our SA equity exposure further, but looking cheap. So what's happening in the world as we look forward and look back? Well, there's more legal action against Trump. That's not surprising. What is surprising is the fact that Trump remains the Republican candidate of choice. You can see there against DeSantis, nearly double the odds of becoming the Republican favorite to go into the elections next year. And elections, unfortunately, do bring volatility. We've got elections in the US next year, we've got elections in South Africa. And unfortunately, more elections means more politicians speaking. And whenever politicians speak, well, markets tend to be volatile. So that is, we are expecting more volatility over the next 12 months, unfortunately, as a result of these elections. And Trump, despite the legal action, certainly has a very strong personal following, and that's why the Republicans can't get rid of him. So unless he gets put into jail, he is going to remain the Republican nominee going into US elections next year. And even from the grave, while Biden is running the US, Trump is certainly having his impacts felt. And we see that Trump's Republican-appointed supermajority in the US Supreme Court wielded its power last week quite phenomenally. The court barred universities from using race as a factor in admissions. The court tossed out President Joe Biden's plan to slash student debt for 40 million people. And the court ruled that a Christian website designer's First Amendment right allows her to discriminate against same-sex customers. Things are not looking so tolerant in the US right now, and I'm very glad that I am not living there at the moment. So Trump, even though he's not in president, he's still causing waves and volatility throughout the US, and I'm sure that will only increase as we head in towards the elections next year. And there will probably be further impacts if Trump does win the elections next year and become president. Well, two of the big factors will probably be the war in the Ukraine and his views on China. So ironically, the war in the Ukraine might actually come to an earlier conclusion if Trump becomes president. The US has pledged $50 billion to the Ukraine, far more than everyone else put together. And that is a lot of money, and Trump doesn't like supporting anybody else besides the US. So there'll probably be an end to US support, or at least monetary support for the Ukraine, which means the Ukraine will probably have to come to the negotiating table a lot sooner if Trump was in power, and that may see an earlier end to the war. Of course, NATO would also be probably pulled into all sorts of volatility, and that may lead to other disruptions, but the war would also end sooner. Similar consequences for China. China may see increased tariffs. Trump does love his tariffs against China, but Trump is unlikely to be able to have the coordinated response against China that Biden has had. So right now, Biden has worked well with the EU, and he's worked well with Japan to have a coordinated chip ban against China. Trump, as we all know, doesn't play well with other children in the school field, and as a result, he won't have that coordinated impact. So China may see increased tariffs, but at the same time, China will probably push towards the rest of the world, and the rest of the world may seem more inclined to work with China. And as we'll talk later about the rise of the global South, we're already seeing that happen. That the very isolationist movements that the US is throwing out there is working against them in terms of globalization, and how globalization is just getting on with it, just not involving the US. So certainly election risks remain, and will be something to focus on over the next year, likely to bring increased volatility to the markets. But one of the bright spots is Japan. We are overweight Japan, and it has worked very nicely for us over the last 6 months. We've got here the governor of the Bank of Japan, Kazuo Ida, and he, in the June policy meeting, kept monetary support incredibly loose, which is very good for Japan. But you can see here, he's saying that Japan will respond quickly if there are any signs of structural change in inflation. So Japan remains eager to respond, but at the same time also very eager to accept inflation, and that certainly has led to a recovery in Japan. As you know, Japan's been stuck in deflation for nearly 30 years since their property bubble burst in the late or early 1990s, and they've been struggling to get inflation ever since. So they're not so eager to get rid of inflation anytime soon, and it's actually working for them. So their ultra loose monetary policy and the strong stimulus has pushed up the economic surprise index of Japan relative to the rest of the G10. So that's the right-hand chart there, just showing how growth is surprising on the upside in Japan, even though inflation is surprising on the downside. And we really like Japan. We remain overweight, not only because growth is looking stronger there than the rest of the world, and inflation is still contained, but Japan is also emerging from lockdowns later than the rest of the world. So Japan, similar to China, had much more stringent lockdowns, and they're emerging from that much later, and that will lead to a more delayed recovery. So while we've already seen the recovery in the US and Europe, we're still likely to see some further strength in China and Japan as those two countries come fully out of lockdown. The yen is also very weak and is likely to strengthen, which should support Japanese equities in dollar terms. And Japanese equities are looking very cheap relative to other developed markets, particularly the US. But what's more exciting is the catalysts, and there are a number of catalysts in Japan in terms of re-rating equities. And this includes corporate governance reforms and government-led structural reforms. So the Tokyo Stock Exchange is implementing reforms on reporting, which should lead to improved auditing, improved clarity and governance, and that should allow investors to feel much more confident in investing in Chinese stocks. At the same time, Japanese companies, a third of Japanese companies that are trading below book value have announced measures to reduce that discount. At the same time, the government is rolling out measures to increase Japan's overall investment attractiveness relative to the rest of the world. And Warren Buffett remains a big buyer of Japanese stocks. He does it on a currency hedge basis, but Buffett and Berkshire Hathaway are always key in identifying value opportunities and quality opportunities, and certainly that doesn't hurt that Berkshire Hathaway has been buying in Japan. So we remain overweight Japan. Japan is well positioned for high economic growth, improved corporate earnings, improved governance, and all of which should lead to better valuations going forward. So a nice place to hide with all the volatility that's going on in the rest of the world. Moving on to the US. The Fed finally, after 10 hikes, has decided to pause. It's very exciting. It was well expected, but it was a very hawkish pause, which is not surprising. The whole mantra of the Fed is to talk up a hawkish story so that they don't have to hike. So it's very important that we remain focused on what the Fed does and not what they say. So yes, they paused, which is important. They did, of course, raise the dot plots. They are saying they are going to raise interest rates twice further this year, which is very hawkish, and data in the US has been very strong. So it's a close call, and they may actually hike once over the rest of the year. It's all very data dependent, and here you can see Powell saying that the July meeting is going to be a live meeting. It's going to be very much data dependent in terms of whether they hike or don't hike. But it falls into our camp of higher inflation, higher interest rates for longer, and that's certainly playing out rather nicely. We have been not concerned about a US recession this year, and that looks like it's playing out. So while markets were actually pricing in 2 cuts, and the second half of this year, the market's now pricing in 1 hike. So the markets have accepted the US is resilient, and that there is a lot of household cash and wealth effect, which is driving that resilience in the US, and employment hasn't fallen as much as it was expected. So the US, if they do have a slowdown, it's going to be a shallow one, and will be towards the end of this year only, or towards the beginning of next year. But all that said, if you look at the charts on the right there, you can see that super core inflation, which is basically inflation excluding everything, is rolling over quite nicely, and will allow the Fed to pause, or at least only hike once at the most, unless things change radically. But we do think that a pause is most likely, despite the fact the market is pricing in a hike. And monetary policy is still very restrictive, and monetary policy does tend to work in a lag, up to 18 months lag, And so there is still time for the restrictive monetary policy to work. And jobless claims are moving. In fact, they're the highest level since October 2021. So the Fed's job is being done, they're raising rates, the economy is slowing down. Yes, it may not be slowing down as fast as expected, or inflation might not be rolling over as much as wanted, but it's a very tight balance between pushing it too far and pushing the US into a deep recession and accepting some inflation. And we do think that the Fed is going to accept a little bit more inflation and err on that side than err on the side of pushing the economy deep into recession. And that's because it's very difficult for them to see what to do. This is the first time that they're hiking rates so aggressively, while at the same time doing quantitative tightening. Yes, 40 years ago, they raised interest rates very, very aggressively. But at that time, QE didn't even exist. Even Japan only started their QE 10 years later or 30 years ago. So I think the Fed is going to be a little bit more cautious in terms of the fact that they are doing QT while quantitative tightening, while they're raising rates. And so more than likely to accept higher inflation and pause in July. But they may hike. The market is expecting a hike, so I don't think it'll have a huge impact on risk either way. Again, it depends on what else they do at the time. If looking into the US, it's very interesting to see that, as I mentioned earlier, the breadth is incredibly narrow. The US stock market's been driven primarily by 8 stocks. It's those FANG mega cap stocks, and the rest of the market's been disappointing and is down for the year. So our view is that as we move into the rest of the year, as it becomes more clear that the US growth is resilient and the US is not currently in a recession, that you'll see some movement out of the FANG stocks and into the more cyclical stocks, the more industrial stocks and bank stocks. So although we remain underweight the US, we are overweight US value, and we do think there'll be some rotation out of the mega caps into more cyclical industrial and bank stocks. Moving on to emerging markets. So as I said, the US has been very isolationist, been very much focused within. It's all about onshoring. It's all about making America great again, and trying to make sure that they penalize China at the same time, so that their largest competitor in the world is held back while they move forward. Now, China accepts that, and they're just moving on with it. So here's a nice photo of Chinese Premier Li Qiang, who is meeting with the French Prime Minister Elizabeth Borne, and they're talking about growing the pie. Very important. They're saying, let's work together. The only way that you grow the global pie is by cooperation, is by globalization, is through global trade, where you have more efficiencies, lower costs, higher revenue, cheaper products, and the standard of living for everybody goes up. It's definitely the right thing to do. It's definitely what they're talking about. And China and France signed a cooperation agreement on a number of things, including aviation, space research, nuclear power, and trading directly in Chinese yuan. And I think that's an important story. It's just another example of the fact that China is becoming the center of a new global trade phenomenon, which is the rise of the global south. The top right-hand chart here shows that globalization remains incredibly high. Yes, if you look over the last decade, it's moved sideways, but what that is hiding is that trade with the US is actually falling, while trade with the global south is rising. And you can see the bottom right-hand chart, China's exports to the US and the EU in the light blue has not risen as fast as China's exports to the global south, which is the dark line, and China's exports to the global south now eclipse that of the EU and the US. So what is the global south? It's pretty much emerging markets. It's Turkey, India, Indonesia, Vietnam, Thailand, Malaysia, Philippines, Brazil, and Mexico. And this chart also includes Taiwan and South Korea. And it's just examples abound of how this is happening. We're seeing Huawei phones across Africa growing incredibly fast. We're seeing Chinese brands displacing Peugeot and Ford in Latin America. Saudi Arabia and China have set up a joint oil futures exchange, which bypasses the New York Mercantile Exchange. We're now trading oil, not in dollars, but we're trading oil in local currencies. Brazil and China have signed 15 deals covering a range of sectors and also trading in local currency. India and Malaysia have signed an agreement to use the rupee in cross-border business. And as I mentioned, even France, which is a US ally and NATO member, is starting to trade with China in yuan. So there's no doubt that trade and globalization is still moving ahead. It's just moving ahead in the rest of the world and not with the US. And to some extent, the US has forced that on China because the US is not willing to trade with China. So China is having to trade with the US indirectly through other countries. But China remains so integral to the global supply chains that can't change. And it is certainly benefiting other emerging markets. And it is a reason why we remain overweight emerging markets at the moment. We also remain overweight China, mostly because it is incredibly cheap, and there's a lot of risks priced in because of the geopolitical tensions. But that said, that although China is coming out of the lockdowns, and we expect that emergence to be slightly delayed, there also has been a very conservative reaction to the slow recovery by Chinese government. They're being very conservative. They're not taking on more debt. They're not printing money. And when it came to the US and Europe, literally the printing presses were running hot. Helicopter money, they were throwing money out of the helicopters and printing money, and people were receiving checks. China and Japan, but China mostly have been very conservative. They've been doing the right thing, and as a result, the economy is not running as hot or recovering as quickly from the lockdowns. So that's disappointed the markets. But yes, China has recovered. Their GDP quarter on quarter was up at 12%, so a fantastic recovery, but likely 2Q GDP was a lot lower than expected. Still strong, but because of the conservative nature of the Chinese government, there has been some disappointment. But we'll see. July is a very big month, and we'll see for China, and we'll see exactly how strong the fiscal response is going to be, and we'll be watching it very closely this month. But even without China, the rest of EM is doing incredibly well, particularly LATAM looking very strong and driving the recovery in emerging markets, which have been incredibly resilient. And it's not just the fact that the emerging markets are now the trade center, but because inflation has rolled over much faster in EM than the US and the Euro, again, because they didn't roll out as much COVID support, it means that central banks in most emerging markets have been able to cut interest rates, and that is stimulating the economies. South Africa, once again, we're lagging that, although our inflation numbers were decent in June. They rose slightly less than expected, but we're still dealing with the inflation impacts of load shedding and all the diesel costs that are associated with it. So our inflation is not falling as fast as other emerging market inflation. So we remain overweight emerging markets, we remain overweight Japan, underweight the US, and yeah, that brings us to South Africa. Smiling, but I'm crying inside, unfortunately, because there are more own goals this month. And as we are just recovering from the Russian crisis and the load shedding crisis, we move into a new risk to South Africa, which is the NHI. And the revolutionary NHI bill was passed this month, and it brings with it a whole host of risks, unfortunately. Yes, national health insurance, or not NHI, but health insurance or universal healthcare is certainly a noble goal, but it's very important that it's done in the correct way. Here you can see the chairman of the South African Medical Association. They're basically slating NHI, and they say, he said, the NHI bill in its current form sets up the healthcare system for failure at the expense of further deterioration of the health and well-being of all who live in South Africa. Basically, it's not being done in the right way, and that's unfortunately quite often the case with South Africa. We have very noble goals. We know what needs to be done, but our execution is lacking. And I suppose we're going to see more of this. Elections are just around the corner, and when we're ahead of elections, governments have to say things that inspire people to vote for them. But unfortunately, NHI is not something that's going to inspire everybody. Unfortunately, NHI is basically nationalizing the private healthcare system. Basically, it's stealing the it's appropriating the healthcare system without paying anything for it. That nationalizing is never a good thing. And it's the exact opposite of what we've just come through with load shedding. You know, I've said often that we didn't really care if SAA went bankrupt, even though they used a lot of tax money to stay afloat, or the post office went bankrupt, or Denel, or SABC, or any of the SOEs, or Land Bank, because there were other alternatives. The problem with load shedding was that Eskom had a monopoly, and there was no other alternative. Fortunately, last year, with the removal of the 100 megawatt license limit, effectively in the small scale and the renewable sector, Eskom is allowing private players to compete, and that has been, you know, one of the key reasons why we can move through load shedding. Now, exactly that we've just come through the crisis, and the government is trying to do the exact opposite and nationalizing, creating a monopoly on healthcare and not letting the private sector support it in any way. And Business Leadership South Africa CEO Busi Mavuso points out, and she's an incredibly bright individual, and she points out that government is completely ignoring the very successful public-private partnerships that happened during COVID-19. Public sector and the private sector worked so well to roll out vaccines and have a fantastic, fast turnaround solution. And why the government is ignoring that, she doesn't understand. And she points to the Affordable Care Act in the US, basically Obamacare as we know it, as a much better alternative solution to the NHI. And the problem with the NHI right now is that it doesn't allow a blended funding model, and it doesn't really work. I mean, even if you have a very high GDP growth, low unemployment, and a trusted government like the UK, it still is very difficult. The UK's NHS has a waiting list of over 7 million people. You really don't want to have anything wrong with you if you're in the UK. 7 million people. And if they can't get it right, chances of us being able to do it are very, very slim. Peter Montalto, who's the managing director of Teledex, estimates that the NHI could cost as much as 460 billion rand a year, and we just can't afford it. More, I suppose, fortunately, there hasn't been a financing money bill from National Treasury, so there aren't any plans to finance it just yet. The health department did say it would take 3 to 4 years to put into place. Hopefully it takes longer, and when it does come into being, is in a more appropriate form, because right now it is not in a good form. Solidarity has taken the fight to the Constitutional Court, and so we'll see how that plays out. Meanwhile, the certificate of needs battle has resumed, and that is something that creates more uncertainty in the healthcare sector, and it's probably going to lead to fewer people wanting to become doctors or nurses, which is terribly tragic, because South Africa already has a shortage of doctors and nurses. So to me, this is a very big risk, something we're watching closely. We definitely can't afford to have doctors and nurses leave South Africa and go abroad, because that'll just hasten the decline in other industries. So trying to move past the bad news and that risk. The good news is that we did have some not as bad as expected data come out in June, and that allowed the rand to recover slightly back to 1880 or so, where we currently are. The right-hand chart there shows, and this is from BCA, just showing as the rand remains incredibly cheap. Fair value of the rand on a PPP basis around 15 rand to the dollar, which is not hard to believe. I mean, the rand was at 14 rand to the dollar not very long ago, so you can see there 2 years ago, but there's a lot of risk, and that risk is being priced in. The IMF came out to talk about the fact that South Africa needs reforms. It's nothing new, and in particular, they focused on SOEs, which need to be reformed to achieve energy security, to create jobs, and reduce poverty and inequality. So while they're talking about reforming SOEs, it is ironic that the health department is talking about creating bigger SOEs. Yeah, as a result, we remain underweight South African equities, but overweight South African bonds. Certainly South African bonds, as you saw, the worst performer over the 6 months, first 6 months of this year, and that's mostly because of a capital loss, which is balancing out a really, really strong income. So if you don't need to live off your capital, South African bonds are an incredibly awesome source of income. Right now, generating over 11% yield. So we remain overweight South African bonds. Our income maximizer is overweight South African bonds and bank NCDs, just because if you can afford to if you don't have to access your capital, if you're in a living annuity or you're in an endowment, to get an 11% yield is phenomenal. Inflation is falling fast, and you're looking at a 5 to 6% real return with South African bonds, which is probably better than you're going to get in South African equities. So we do think it's a great place to hide. South African property is also looking more attractive. It's also been a terrible performer over the last 6 months, negative returns, but it does face some structural headwinds. And although the yield is getting more and more attractive, we still think it's safer to be in South African bonds from an income perspective. So how does this all look, putting it together? Well, the bad news is that markets have done incredibly well over the first 6 months of the year, and that's exactly how we expected it. The beginning of the year, we were over equities because the market thought that there would be a V-shaped performance, because there would be a recession in the middle of or early this year. Markets would fall and then they'll recover towards the end of the year. We thought it'd be the opposite, that markets would rally into the first half of this year as the recession gets pushed out further and further into the end of this year. In fact, now it's looking like the US recession, if the soft landing is going to happen, possibly even as late as early next year, which means that equities might even stabilize from these levels. But as I said, the bad news is we have done this, and equities are looking very expensive in the short term. The CNN greed index is in extreme greed, so we are expecting a pullback in the next few months, but we're not expecting a deep pullback. Why not? Well, because there's no major imbalances, and if you have a structural deep recession, it's normally because there's too much debt in one part of the market. And right now, all the debt is sitting in the government sector, and the consumers and corporates have deviated quite nicely. And the nice thing about the governments, if they take on debt in their local currency, well, they can just print their way out of debt, so it's unlikely to cause a recession. So no major imbalances, which means that if equities do pull back over the next 6 months, which we do think they will, just probably maybe 5%, that it's not going to be a deep pullback. Other reasons are high cash balances. If you look at the top right-hand chart there, you can see that that shows excess cash levels since the beginning of COVID, sitting in household bank accounts relative to pre-COVID. COVID, obviously, there was lockdowns, people had to save, there were forced savers, and those cash levels are still looking pretty high. The pink bars shows the fourth quarter of this year, and you can see that although there are still strong cash household balance levels in the US, those are almost normalizing by the end of this year, which again talks to the fact that the resilience of the US against high interest rates and high inflation is probably going to peter out towards the end of this year, and we could have that soft landing come through. And I suppose it also allow the Fed to not have to raise rates, because they can see there that households are running out of cash. But Europe and the UK and Japan certainly still have very strong household cash balances to keep their economies bumbling along despite high interest rates and high inflation. The third risk, which we seem to have gone past, is the US regional banking system, which looks like the flat fallout has been contained. And the fourth risk is inflation, which continues to fall, slightly ahead of expectations. and it's been buoyed by lower energy prices. And BCA point out that if you look back over the last 40 years, when inflation gets below 4%, which is what we're expecting over the next 6 months, real earnings turn positive. So we are, despite the fact that growth is probably going to slow down into the end of the year, at the same time we've got real earnings being supported through lower inflation, and that again is probably going to hopefully will balance itself out and allow a soft landing and again more of a bumbling along towards the end of this year. So we're still expecting our triangle markets, but not a strong pullback into the second half of this year. But that said, risks do remain. So the first risk is the counteroffensive in Ukraine against Russia, and in particular Wagner's push towards Moscow. And although that push was halted, it certainly created a perception that Putin doesn't have as much power or control over Russia or over the war as he would like to be perceived. And that means that he might do things, certainly if the Ukrainian counteroffensive starts to gain traction, Putin might be forced to try and fix that perception and either do a lot more saber rattling and talk about nuclear options, or cut the supply of oil and natural gas further, or just basically raise tensions in Europe. And while certainly Europe is a lot more energy dependent, there certainly can be some volatility into the second half of this year that may cause downside to equities. The other risk, which is well telegraphed in the US and is why the US is expecting a slowdown in the second half, is the fact that interest rates are very high because of high inflation. But it's worth looking at the bottom right hand chart there, which you can see the impact of debt servicing levels. So the headwind to growth is service costs, which is a combination of how much debt there is and how far interest rates have risen. And then the third factor is whether people use more variable interest rates, which is short-term interest rates, or long-term interest rates, because the yield curves remain inverted. So short-term interest rates are much higher in the developed world than long-term interest rates. So countries that have used much more variable or short-term interest rates, short-term debt, such as Canada and Australia, are feeling the pinch far more than the US. So the US is on the very left-hand side of the chart. You can see there that the debt servicing costs haven't really risen much over the last year, and they've still got a lot of cash at the household level. So that's why the US consumer has remained resilient. However, if you look at on the right-hand side, Australia and Canada, they're seeing a much further headwind to consumer spending as a result of increased debt servicing costs because of that variable interest rate. And that's also influencing their housing market, and we're seeing much bigger decreases in pricing in Australia and Canada, which again, through the negative wealth effect, is going to slow down that consumer. So we do remain underweight Australia and Canada, just from a concern that the consumers there won't be as resilient as Europe and the US and Japan going forward. So we do think well, risks remain. We do think that equities are expensive and could have a pullback. So we've got protection on at the moment, but we don't think it's going to be a deep pullback. And anybody with a 6-month or longer time horizon should stay invested and look forward to more clarity into next year. Now, next year also could bring further risks, but we'll have to wait and see how that pans out with the data. In the interim, we still remain overweight our key themes, our sustainable economy theme, our emerging consumer, which is basically emerging markets, so the next billion consumers, our fourth RR fund, which has done quite nicely over the last 6 months. It has recovered in the last month or two, and healthcare, which, while it's done well over last year, has slipped a little bit in the last few months. And we think that those passive themes remain great structural overweights over the long term, and as a result, we're overweight global equities, underweight South African equities, overweight South African bonds, but with protection against a pullback in markets, a small pullback. And that's cheap derivative protection. We wouldn't actually sell out of physical because that is quite expensive. And that is a wrap for today. Let's have a look at questions. Evelyn asks, how do you believe the FANG stocks perform for the rest of the year? Evelyn, it's very difficult to predict short-term performance. And I do think that the increase in the FANG stock prices is justified because the change in artificial intelligence has a meaningful impact on these big FANG companies. That said, I think they also are priced in for perfection in the short term, and that's why we remain underweight the US. And within the FANG fund itself, we are rotating out of some of the very expensive ones. So some of the stocks are priced for perfection. Nvidia has a phenomenal return. It's nearly tripled year to date. And from Nvidia, if you look at growth and its PE, it has to grow earnings by more than 20% for the next 20 years to exit on a decent PE. So we're rotating out of some of the more expensive stocks within the FANG fund into stocks that haven't benefited as much by the large language model artificial intelligence boom, and so we have positioned it a bit more defensively. But we think that the FANG stocks will underperform on a relative basis compared to the rest of the US going forward over the next 6 months. There's a long political question that I'm just trying to get through. Yeah, Mr. Naka, I think that's rather a political question. I do agree with your views, but we'll pass on that. Bradley asked about our progress on crypto. Bradley, we stay very, very closely. We watch closely what's happening in the crypto space, particularly in the distributed ledger space. We are looking to launch something in that space, but right now legislation doesn't allow us to do anything. But we can see that the rest of the world is moving forward with regulation, and hopefully that will allow us to do something in the short term, or in the medium term. But for the moment, we not allowed to do anything further in the crypto and decentralized ledger space. Hi, Annette. You can get a replay of this presentation on our YouTube site. So just go to the Sygnia YouTube site, and it has a copy of all our presentations, all our webinars, not only the monthly macro ones, but the other ones that are done as well. Andre asks, when the Rand is weak, is it more prudent to invest in Sygnia local or global funds, and vice versa if the Rand is strong? Andre, it's a very, very good question, and it's something that's very difficult to do. Unfortunately, as South African investors, we're faced with the volatility of the Rand. The good news is that from a balance perspective, where we have both South African equities or South African assets and global assets, we have the flexibility to use derivatives to try and protect and manage that exchange rate risk. As an individual, it's much more difficult because you might say, well, Japanese equities are cheap and I want to buy them, but the Rand is weak, so I don't want to. And what do I do? Unfortunately, there's not much option. And besides investing in the Sygnia funds, where we do have that flexibility, so in the Sygnia balanced funds, or the alternative, which is just to invest over tranches and wait, Rand average your input. In terms of our Rand outlook, I know someone's going to ask me, so I'm going to give that. We do still think the Rand, as you saw in that chart, from a purchasing power parity basis, the Rand is very weak. Yes, there are risks, but I think one of the one of the factors that has been driving the weak rand, well, it's interesting. So last month I showed a chart that showed how the rand had decoupled against other emerging markets, and how by nearly 2 rand a share, and emerging markets had decoupled from developed markets because of low growth. In June, the rand recovered all of its losses against other emerging markets. So all our idiosyncratic risk has disappeared. Which I suppose is a good thing. I think there probably should be some sort of discount in South Africa against other EMs, but right now that's all disappeared. But the spread between emerging markets and developed markets has actually widened, and that's happened at the same time as commodity prices have fallen. So what we've seen is expectations of a global slowdown into the end of this year, driven by a US slowdown, and the fact that China hasn't given as much fiscal support or helicopter money as was expected. So a China that hasn't recovered as fast as expected, and a slowing US has led to a slowing global expectations. And that's led to lower resource prices, and that's led to lower emerging market currencies, and that's what's weighed down on the rand. So looking over the next 6 months, there's a lot of volatility, as I said. We could have a risk-off environment, which obviously would lead to a bit more rand weakness and EM currency weakness. But looking through that volatility, we do think that there'll be expectations of less pessimistic growth going forward, which means that resource prices will recover, and emerging market currencies and equities will recover, and so the rand will recover. So we're going to be watching. So the catalyst for that is going to be China over the next month. They have their big Politburo meeting, and if there's sufficient stimulus, well, then commodity prices could recover, emerging market currencies could recover, and the rand could recover. So we are waiting to see. But our baseline is the rand has got further to recover before the end of the year. Maybe it's delayed until next year, but it's hard to see. But right now there are risks. As I said, there is the triangle. So we think there's more downside in the very short term, and that's we hedged against. So I would tranche any investments over the next couple of months. Bruno asks, to what extent is the market prepared for a second wave of inflation in a few years? And I think, Bruno, you've hit the nail on the head with that one. It is what we've been concerned about in our triangle. We thought that the US would be resilient, but that exact resilience is what leads to inflation not falling as fast as possible, particularly in the wage inflation. And that does raise the risk of inflation bouncing and forcing the Fed to then start hike rates again. So I think the catalyst for the next recession could be in a year or 2 years' time, when the Fed has to get aggressive and start to raise rates because inflation doesn't fall as much as expected. And we are, to some extent, sowing the seeds of our doom later on. But I do think that that's the way it happens, that generally, I mean, again, we might get it wrong. The Fed might be incredibly hawkish, and other central banks, and they might raise rates more than we think this year, and they might force a recession now to avoid a second wave of inflation later on. But I think generally, central banks tend to not want to cause unemployment to rise too soon, and they will err on the side of higher inflation. So kicking the can down the road seems to be the policy response over the last 40 years. And I can't see any change in the outlook of that now. Wayne, as I mentioned, there are no proposals in place yet to fund the NHI, and that is why a number of people, including Discovery, are saying that it's likely to only be implemented over the next 10 to 15 years. And by that time, it should be hopefully closer to Obamacare and less close to the UK NHS, in which case it will be more affordable and more sustainable. But we'll have to wait and see how that plays out. Bruno asks what effect the issuance of bonds by US Treasury is impacting liquidity. That is definitely a risk. We did raise that risk last month in the Q&A. There's definitely some uncertainty with raising interest rates while the Fed does quantitative tightening at the same time. It's something that the impacts of QT, the impacts of the Fed reducing liquidity by removing those bonds from that liquidity from the market as they absorb those bonds is something that is a concern. We're not quite sure how it will play out, and is one of the catalysts for risk and for markets pulling back in 2H. But at the same time, it's very, very easy for them to pause QT or start QE again, as they have many times over the last decade. So I think the Fed will be watching it quite closely. They're aware of that risk. It is definitely a risk and will lead to a stronger dollar and falling equity prices and stronger bonds if that does happen. Another question from Bruno. Talking about a question on the yield curve control. So yes, the yen has been incredibly weak, and most forecasters and strategists are expecting the yen to strengthen. Why? Because one of two things can happen. Either inflation remains high in Japan, which will force the Bank of Japan to abandon yield curve control. Currently, the 10-year bond is fixed at 50 basis points, 0.5%, and if inflation doesn't roll over, they'll be forced to raise that like they did from 0 to 50 to 1%, in which case the yen will strengthen. Or inflation in the rest of the world will fall, and interest rates will fall, or bond yields will fall in the rest of the world, and the disparity or the difference between rest of the world bond yields and Japanese bond yields will fall, and the yen again will strengthen. So the outlook for the yen is very positive. The yen will strengthen either way, either if inflation doesn't roll over or it does roll over, but it might take a while for us to get to that point of either inflation falling or the Bank of Japan being forced to abandon yield curve control. So for the moment, we're playing a wait and see on the currency, and we don't own any Japanese bonds. Bradley asked a question: what would Sygnia do with regards to asset allocation if we see the threat of World War III increase? Bradley, it's a good question, and it's a difficult one. If you look at any modeling, any back test of any asset allocation, it will always want to include some defensive asset classes that do well in a risk-off environment, whether it's gold or global bonds, because that reduces the overall volatility. Now, that is acknowledged. At the same time, all that modeling also agrees that by including gold and developed market bonds into your portfolio over the long term, you give up return. So if you have a long-term investment, if you're saving for retirement, you don't need to, well, there's not the necessity to focus on short-term volatility and give up that long-term return, which is why in our long-term funds, our balanced funds, we don't have gold or developed market bonds, because we are prepared to accept a bit more volatility for, in return, a higher return, because we can look through. We're investing for our retirement, which is at least 10 years away, and we can accept that volatility. If you are focused more on the short term, well, then you have other options. You can get a fantastic, right now, the Sygnia Enhanced Income Fund is giving you over 10% return. It's a fantastic place to hide. 10% return, no volatility, and if you expect the probability of World War III to increase or a significant recession, then you're getting 10% in rands and with very little volatility. If you're particularly focused on World War III, and yes, things are looking quite heated, although it's certainly not our base case. There's a very interesting index you can look up. It's called the Bloomberg FANG2 index, Bloomberg FANG2, and it invests in national security and resource security, basically guns and oil. So that's something that if you think that the probability is going to rise, and as a result, those assets might rise, or then it's something that you could look at from a global perspective. We don't have an ETF on it. It's not our base case, and so we don't invest in either guns or oil at the moment, besides obviously some Sasol exposure. But that is one way to play that threat. As I said, our base case is that we're going into elections. There's going to be a lot of mudslinging, and risks will increase and volatility will increase, but it's better just to look through that volatility, hold on to your quality assets that are giving you good return on equities and good cash flows around the world that are diversified, and stick to that. Maxwell asks about the graph in terms of the label. Possibly it's the wrong way around. ZAR USD as opposed to USD. But basically, if with the chart needs to come down, which means the rand needs to strengthen to get to its purchasing power parity equilibrium. Altus asks a great question. He says, you previously said that the Skeleton Balance 70 fund is your favorite fund. Why? And why not a well-diversified fund like the Skeleton International Equity Fund of Funds with no exposure to South Africa? Altus, brilliant question. And the answer is quite simple. It's regulation. Skeleton Balance 70 is a Reg 28 fund. It can't have more than 45% offshore, and it can't have more than 75% in equities. As I said, I've got my entire RA in that fund, Skeleton Balance 70 fund. There are some regulatory constraints, so I can't put my RA into the Skeleton International Equity Fund of Fund. But the global equity portion of the Skeleton Balance 70 is invested in the Skeleton International Equity Fund of Fund, so I am getting the exposure through that, just with some mandatory SA exposure as well. And despite being on almost on the second half of my 40s, I do have still a while to go until retirement. So actually be quite comfortable investing in the Skeleton International, or at least 100% equity fund, but Reg 28 doesn't allow 100% equities. So I have to have some bonds. And if I'm going to have bonds, well, I do like South African bonds. I think that they've got close to the highest real yield in the world, and it does give you some rand exposure, which again, I'm not retiring in the next 5 years, so I can afford volatility, but it is nice to have that diversification. Paul asks, what impact did the ZAR strength have on the Fourth Industrial Revolution Fund? Yeah, that's Paul. As I mentioned, that's the key problem for South African investors, is that we have to balance a pullback right now. Fourth IR, or that has recovered in the last month, it's still looking very cheap compared to its history. So you'd like to top that up, but the rand's also, even though it's come off its weakest levels, it's still looking rather weak. So how do you balance those two? And it is a tricky answer to have to worry about that. And the only thing you can do is really spread your investment over tranches to try and get a blend of equity weakness and rand strength. Trevor asks, will the dollar weaken dramatically over the next 2 to 3 years, benefiting the rand and other currencies? Trevor, on a purchasing power parity basis, which is a 10-year view, the dollar remains the most expensive currency in the world, and very, very expensive. It's probably going to weaken 10 to 20% against DMs. But if that's a long-term view, and it might happen at only 1 or 2% a year, nothing dramatic about that. And in the short term, if we do have a risk-off environment, we could, again, the dollar could strengthen, which would mean the rand would weaken further. So it's very difficult to call the dollar. I'm certainly, I believe in the fact that the trade is moving away from the dollar, and a good portion of mostly commodity, 80% of commodity trades is done in dollars, which means that people have to, emerging markets and other countries around the world have to have dollars to be able to trade in commodities. As those commodities move out of dollars, the natural demand for dollars is just going to fall. And that means I think the dollar will, over time, continue to lose its status in terms of global FX reserves and trade. But it's not going to be dramatic. I think it's going to be a slow trickle out of the dollar. Nothing too quick. But on a 10-year view, certainly pricing in dollar weakness. Pierre says, what do I expect the Rand dollar exchange to be at the end of 2023, 2024? So I'll bring up my crystal ball and try and predict the future. If we go back to that purchasing power parity chart, I don't think we're going to get that strong, but assuming commodity prices do rebound, and I think they will, driven certainly by copper. And a very interesting chart, which I'll show next month, is just the current reserves inventories is the word I was looking for. The current inventories of commodities, particularly in China, are at decade lows. So even if there's not as much recovery in growth as China and other countries start to restock in commodities, that'll support emerging markets, it'll support emerging market currencies, which will support the Rand to some extent, and ignoring idiosyncratic South African risks. The Rand should strengthen a bit further next year, and if you look at economists' forecasts, economists are forecasting the Rand to be at 17.50 towards the end of next year. So in 18 months' time, the Rand should be at 17.5, and that is expected return of the Rand. So we'll see if the economists get it right or wrong. But I certainly am on that side. I think the Rand is going to strengthen, not weaken. Oh, there we go. Question about my view on the Rand. Bruno again. Bruno, I'm going to ask you to co-host. Asked about the headwinds from decarbonization and demographics pointing to higher inflation. Now, I could talk about that for an hour. I don't think that's. Yes, I do think that there is some inflationary headwinds from decarbonization. And I do think that demographics have got a mixed view. Some people say demographics is inflationary. I don't think so, because I look at Japan as being the framework. So I still think the world is in a deflationary environment, that Japanification is the global framework. Yes, Japan has had a short-term bounce in inflation, but there's nothing that suggests that is structural and going to remain. So I think that we'll see deflation returning to the world. It won't be as disinflationary as in the past, because decarbonization will lead to some inflation. But I definitely think that looking 3 or 4 years out, inflation gets back to the 2% target, if not lower, in the rest of the world, just because of a lack of demand. And that's the demographic headwind that Japan has been facing, and populations are aging around the world. So we'll see how that happens. The other aspect that could keep inflation lower is productivity, and the fact that it'll make goods and products cheaper. Certainly, we'll be watching the productivity line. Productivities are nothing of the last decade, but maybe the resurgence in AI and robotics will improve that. So we'll have to see. But I remain in the long-term deflationary camp, not inflationary camp. Alex asks a difficult question. How has Sygnia's bullish view on China evolved the last month? It hasn't changed, but it's definitely something that we are reviewing very, very closely. And we'll be watching to see what response comes out of the government this month. So I think you need to look at Japan, and so China as a whole. China's looking incredibly cheap. It's one of the cheapest emerging markets. And it's certainly got tailwinds as it comes out of the lockdown. So we've got growth recovering, we've got the fact that it's very cheap, we've got interest rates being cut, we've got piecemeal fiscal response that's supporting growth. But that said, the deflationary impact from the the bursting of the property bubble is a concern, and the fact that the government is being very conservative is a concern. Now, the government is just worried about taking on too much debt, and that is a valid concern, and that they are worried about how much debt the US took on and Europe took on during COVID. But at the same time, they may need to take on more debt, and that's because structurally, China is a very high savings culture. China's got high savings rate in the world. So if you are saving in, if you're putting your money into bonds, well, those bonds are debt to someone else. So you have to have debt, and they've got a very, very small equity market relative to their debt market. So that's why they're quite different to Europe and the US. So with a very, very strongly developed debt market and very high savings rate, they are going to have high levels of debt, and as a result, possibly the government doesn't need to be as cautious as they are. So we're going to see. We like China. It's cheap. It's got tailwinds, but if there isn't sufficient stimulus from the government, it may be stuck in a value trap, and then we may have to cut our position. We'll stay overweight, but we may have to cut our overweight position to a smaller overweight and wait for that to happen. So no change to our view yet, but we are reviewing it very closely, and we're waiting to see what comes out of their July meetings. Pleasure, Annette. Mark, if there's a blended funding model, then private healthcare and NHI can work together, but if there's not, then there's no space for private healthcare. It will all be nationalized, which is what makes it so difficult. Right now, the health department hasn't been able to properly manage the existing healthcare sector. We've got a shortage of doctors, a shortage of nurses. You've got infrastructure which is decaying, long waiting lines. So the chances of them being able to manage a much larger department is hard to see, and that is why everyone is concerned about the current model, which doesn't allow the use of private healthcare in conjunction with the public healthcare system. Pleasure, Frederick. Alex asked a question about market breadth in the US. Alex, it all depends on how quickly we come down from this triangle and what causes a pullback. But we think over the next 6 months that market breadth will increase or improve in the US, and there'll be a rotation out of those FANG stocks into the broader market, industrial stocks and financial stocks and banking stocks. But we'll have to just wait and see how that happens. Naveen asked how the Sygnia Enhanced Income Fund has done compared to our money market fund. So the Enhanced Income Fund has beaten the money market fund, as we'd expect it to do. It's got higher credit and longer term, not duration, but longer term. So it's got a higher yield, and it's a great place to be. It's got a bit more risk than the money market, but a decent return. The next fund up is the Income Maximizer, which takes on duration risk that holds bonds. And although that's got a high income yield, and if you want yield, but you don't need capital, and that's the place to be. But because it does invest in bonds, it's very volatile and it's at a much lower total return. But the income has been the highest of the three. So the highest income is from the Income Maximizer, but that is because it takes on some volatility. So if you're very conservative, you want to be in the money market fund. If you're prepared to take on a little bit of volatility and you want a higher return, you go into enhanced income. And if you don't need access to your capital and you want the highest income, you go into income maximizer. Those are our three income product ranges that are currently all doing very, very well. So we've only seen the provisional numbers that have come out. But as at the end of June, our money market unit trust was number 1 out of 43. And the skeleton balanced absolute fund, which is also a part of our Zen campaign or low risk funds, was top decile, looking incredibly good as well. So we've got a lot of great funds that you can invest in if you are conservative. Money market, enhanced income maximizer, or if you want sort of an absolute return, which gives you a real return over the medium term, but has capital preservation focus in the short term, then the skeleton balanced absolute fund is for you. Hi, Tom. Just reading to your question. So Tom asks a very good question. He says, will the new world order, the rise of the global south, be better for the world than the last one? And I don't think so. The US is definitely, it's got the most efficient capital markets in the world, and BRICS, although they are being forced to come up with their own solution to that, because the US is excluding them, BRICS working together is better than them not working together. But it's going to be a rather bumpy ride. I mean, there's a lot of difference in ideology between the various emerging market countries that makes it for a difficult collaboration. We've seen that France wants to attend the BRICS summit here in South Africa in August, and they can't decide whether that France should be allowed to join. And there's been uncertainty about whether the BRICS should extend its membership. Certainly, their ability to decide on a BRICS currency, I think, is very unlikely. So the world is being forced to work without the US, probably the best way to say it, and the world is getting along without the US, but it doesn't mean that it's going to be a better solution than what we had when everyone was working together. It just means that the emerging markets have matured over the last decade, and they are able to take up some of that slack as the US slows, as the US grows, and as the US sees its aging population and high debt levels slow its growth. So I suppose it's an evolution, but it's not a clean evolution. It's rather a bumpy one. Colin, I think I've just answered your question on the BRICS currency. Yes, it would be great, but I don't think it's going to happen. Pleasure, Mike. Pleasure, Gregory. Thomas says the Sygnia Skeleton Worldwide Fund is doing well. Thank you, Tom. Yes, it is. It's a funny category because it's got like a lot of different funds in it, and everyone has different benchmarks. So it's rather an awkward fund, but it continues to do quite well. And I do like that fund as well. And that's it for all the questions. Thank you so much, everybody, for joining. It was great to be able to chat to you. I hope you have a good July. I hope the markets give us a good July like June, but I think that we're probably going to see some sort of volatility as we do when we go into the traditional Northern Hemisphere summer. The liquidity reduces, volatility increases, and we get a bit more bumps and negative returns. So I think sit tight and prepare for a bumpy July, but hopefully not too bad or too bumpy. All the best.